information useful for decision making. And when I put the two together, I said accounting is past looking, present looking, and future looking. Now we'll talk of reporting standards. Generally speaking, we say accounting is the language of business. Say accounting is the language of business. How beautiful it will be if accountants globally speak a common language. But our language differs. A professional accountant, for example, in Africa or Nigeria to be specific, who is a professor of accounting and belong to the two major professional bodies we have in Nigeria, will not be allowed to practice when he finds himself here in the United States. He will be requested to write the AICPA examination before he can practice. The same thing, we have some people who are qualified professionals from the United States. Some of them are in my country, Nigeria. They don't allow them to practice as an accountant until they have enrolled with one of the two professional accounting bodies in Nigeria. But we say this is a gap. It's not supposed to be, because debit and credit, as discovered by the Italian priest Luca Pacioli, 1494, is the same globally, irrespective of where you find yourself as an accountant. And it's one of the reasons we now say, let us have a global set of reporting standards, so that if I have set of transactions in United States, and I give those transactions to you, prepare financial statement. I give the same transaction to another person anywhere in the world, prepare financial statement. It will be uniform. So one of the key reasons for the adoption of IFRS, even though we are aware United States have not adopted IFRS, but one of the key reasons for the adoption of International Financial Reporting Standard is to allow uniformity, is to bring about uniformity in the way we prepare financial statements. And the three key objectives of adoption of IFRS are accountability, transparency, and comparability. These are the three key objectives of the adoption of International Financial Reporting Standards. Now, when we look at GAAP, Generally Accepted Accounting Principles. Before now, that's in my country, Nigeria, we have what we call Nigerian GAAP. That's Nigerian Generally Accepted Accounting Principles. As a matter of fact, what we just did, we borrowed from the US GAAP, just tailor it to meet our own local requirements, and we now came up with what they call SAS. SAS means Statement of Accounting Standards. Statement of Accounting Standards. And we have a lot of those gaps. And when you ask me, what do we mean by IFRS? They are a set of global reporting standards. Overview of IFRS. They are a set of global reporting standards that is being published from time to time by the Accounting Standard Board. They are based in the United Kingdom. As at date, we have what is called IAS 1. It terminates at 41. IAS 1 is presentation of financial statements, and IAS 41 is on agriculture. That is, if you pick agriculture, all the relevant financial statement that you need to know to prepare about agriculture, you find there in IAS 41. Then we have IFRS itself. That's IFRS 1, which is first time adoption of International Financial Reporting Standard. And we have about 15 of them. Now, if you now combine the two together, that IAS 1 to 41, then IFRS 1 to 15, then we have the various interpretations. It is the collection of all these components that make what we call International Financial Reporting Standards. And I will quickly tell us, back home in Nigeria, we believe one of the reasons United States have not adopted IFRS is that, number one, they feel the gap for example, is over 20,000, voluminous. I don't know if you have gone check online. The document, that's the gap is very voluminous. But IFRS is just about 2,000 pages or more. IFRS. I've said the key reason, if you ask me, the key reason for the adoption of IFRS by countries who have adopted, because Nigeria, we have adopted IFRS. As a matter of fact, the regulatory body in Nigeria gave 2012, they mandated all companies in Nigeria to adopt the IFRS, that's International Financial Reporting Standard. Now, when we talk of GAAP, generally accepted accounting principles, I think we've done that. There are just rules, guidelines, regulations, norms, conventions, such as we have the historical cost concept, we remember, the going concern concept, materiality convention, consistency convention. We have the ACRA concept. We have the matching concept, mentioned there. Then going concern concept. These are the items that form the generally accepted accounting principles. Now, when we talk of GAAP-based financial statements, that is, let us have a look at the financial statement, component of financial statement we prepare when we are still using GAAP. Remember I said earlier that we borrowed from the US GAAP, then we tailor it to suit our own local environment, and we came up with what we call Statement of Accounting Standards in Nigeria. Now we have 11 key statements that if you are preparing financial statements based on the Nigerian GAAP, or what I refer to as the Statement of Accounting Standards, you are expected to prepare minimum these 11 different statements. Number one, the income statement. Another name, somebody can give us, let's make it interactive. Another name for income statement is what? Anybody? Profit and loss account. You know, under GAAP, that's the language you call it, profit and loss account. But when we come back to IFRS now, they say there is no how you can have profit and have loss at the same time. That one has now been changed to profit or loss account. You either have profit or you have loss. And when you take income statements, what the income statement, what do we expect to see? Typical income statement. Your turnover, your cost of goods sold, then you have your gross profit, then you deduct your administrative costs, you deduct your selling and distribution costs, you arrive at what we call operating profit. From the operating profit, you deduct the fixed interest charges, and you add the fixed interest income, then we have what is called profit before tax. Then you apply the tax at whatever rate. Once you deduct the tax, you have what is called profit after tax. Then the next thing is, how do I distribute this tax among the various stakeholders? How much of this profit after tax is going to preference shareholders, ordinary shareholders, and what is my retained profit? That is the typical thing you find income statement. Now another statement we have there, balance sheet. What is a balance sheet? Let's make it lively. Communication is two-way. Don't allow me to do all the talking. Balance sheet, what can we, any contribution? Balance sheet. Then another question that will follow is balance sheet and account. You know, if you say ledger, debit, credit. Then if you say profit and loss or profit or loss account, you may decide to do the T form. But balance sheet, without wasting time, any contribution? What's your balance sheet? You have an idea? A balance sheet is not an account. A balance sheet is a position statement, a snapshot depicting the state of affairs as at a particular date. That's a balance sheet. A balance sheet is a position statement, a snapshot of the state of affairs of an organization as at a particular date. So that if you take a balance sheet, I know in United States, that's the comparative financial statement. In United States, when you take the balance sheet prepared in the US, you realize it's almost the opposite of what we do in Nigeria when we still prepare balance sheet. Where we have our assets, as we have the assets, no marker, I don't know what you're talking about. How this working?
Another one is the
Another one
that's
somewhere here.
works.
In Nigeria, if you are preparing balance sheets, if I write here balance sheet, I'll put as at whatever date.
31st December.
Then what you have here is fixed assets. And when you say fixed assets, you can be talking of land and building, motor vehicles, that's MV. Then say machinery.
Pictures.
If I have all this, the total, we have what is called total fixed asset. Then immediately, I'll come here and say current asset. Current asset here, you begin to talk of stock, you talk of debtors, you talk of prepayment, and so on. Then we have what is called total what? Total current asset. Then you say total assets. If I leave this one A and I say this is B, my total asset will be what?
A
plus B. Then I have the addition of this. Then I'll come back to this side. That's how we do it in Nigeria. Always. You understand?
Opposite.
Huh?
I think here is the
Opposite.
It's the opposite. That's where I'm going. That's comparative financial statement. In the United States, it is the opposite. The asset are here, then the capital and liability on this other side. So here you come, you say ordinary share capital. We have this. I can say 5% preference share. I will have this. If I total this, that is the capital. Both the one belonging to the shareholders and outsiders' interest. Then you come here and talk about long-term liabilities. Here we talk of loan. You have this. You can say 6% debentures. You have this. And total is, they give us what? Total long-term liabilities. Then we talk of short-term. See here, short-term liabilities. And under the short-term liabilities, we talk of creditors. We talk of taxation, if we have tax unpaid. Then we can talk of accruals. When you have this, we have what? Total short term. If I give this one now, C, D, and E. We already have A and B. I will now say total capital and liabilities will be the addition of C, D, and E, which must be equal to, that is balance sheet in Nigeria. If you talk of United States, all you just need to do
Transfer.
to interchange the position. It means an accountant in Nigeria who happen to find himself in the United States and do it the Nigerian way, done the wrong thing. And it's one of the reasons we're not talking about uniformity in the practice of accounting. Now, the next one we have here, cash flow statement. What's a cash flow statement? I saw the
Professor, I just want to ask my students as well, besides splitting that balance sheet, GAAP also changes the nomenclature, the US GAAP. I just want to ask you if some of you know, especially those that are international, fixed assets, what do we call them here? where motor vehicles there are land activity.
PPE.
Proper planning.
Mm-hmm.
Good. What about under current assets? You see, we have stock. What do we call that one here? Inventory. Yeah, we shall come back to that.
Inventory
That's
and
inventory,
gas.
and then debtors. What do we call debtors here?
For what?
Debtors.
Debtors,
What do we call it?
Account receivable.
Accounts
Receivable.
Good. And then on the other side, ordinary share capital. This way, that's what that's shareholders equity, which has common stock. To be more specific, ordinary share capital is actually common stock or equity capital. Equity capital. And then preference shares, we mostly put that under debt, especially if it has that feature, the cumulative
feature of the cumulative preferential. Some have convertible
Convertible,
to ordinary shares. In
Right,
future.
yeah.
I think that step is
Then-
also first we current assets and then fixed assets. We
Yeah,
have
order of
the
liquidity.
office the current.
Okay, what are the
assets,
obligations?
like-
Current come first,
And
then
then, yeah,
fixed.
and then other.
Then under short-term liability, creditors, what do we call those?
accounts payable.
Account.
So it means this is a good exam question that
Yeah.
the lecturer give you this and spot the difference. What's the difference between this and United States balance sheets? A lot of difference there. And that's why one of the things we observe that United States, instead of throwing away GAAP and adopting IFRS, what they are doing to look at the two together, they look at the IFRS, they look at the GAAP, and they draw a feature that will be relevant. Because under IFRS currently, all these have written fixed assets here, they call it non-current assets. Right. Then when you add this, and this together, they call it property, plant, and equipment, which is part of the things they are changing now. Instead of US now saying, okay, we have adopted IFRS, they are not changing. That's a good one. It's also inventory. Under IFRS, they call this inventory, receivables, prepayment, and so on. Now, when we say cash flow statement, without wasting time, we know cash flow statement very well. I think I go through some of the very wonderful questions, assignments, given by the lecturer, Dr. Joseph, to you guys in the class. I saw that from my wife, she's there, when she do her assignments, I look at some of them. I've seen cash flow there. Cash flow is the statement that explains the difference between liquidity and profitability. Why is it that some businesses will disclose after-tax profit of $5 billion, for example, and the same company is struggling to pay a debt of $100 million? See something? Profit after tax, $5 billion. Yet the same company is struggling to pay a debt of $100 million. How do you reconcile this? And that's the reason some people say accounting profit are paper profit. And one quick reason for this is, in accounting, when we say sales are sales, that's another one for turnover, whether they are cash or credit. So that in the financial statement, you will just see turnover, $10 billion. It is possible that out of that $10 billion, $8 billion are on credit. They won't be cash available. So the statement that will show us the cash flow in the organization is the statement of cash flow, or they call it cash flow statement. And you know the components of cash flow statement? Cash flow from financing activities, cash flow from investing activities, cash flow from operating activities, operating, financing, investing. Then you have the net and cumulative cash flow. Value added statement is the next one we prepare when we are still using the GAAP. When we say value added statement, we are just saying what is the additional wealth created as a result of the use of resources, and how have you shared these resources among the providers of finance. Chairman's report, that's company account now. Director's report, auditor's report. I'm sure you also do auditing here. Auditor's report, the one you issue at the end of the day to declare whether financial statement represent a true and fair view. When you go deep into that audit, I'm going to talk of qualified and unqualified audit report. Let me be fast. Then we have the audit committee's report. We have the statement of accounting policies, notes to the account, and 5-year financial